Yes, the select few here, not so many of us looking at motor. I mean, I'm Joseph Fimbo, as a senior client manager. I work predominantly with captive clients at FiscalReps. And this is my colleague Alessia, who works within the insurers practice, so dealing more with general insurers, but is also, I'll probably tell by the name, our native Italian. With the complexities of Italian motor taxes, it comes in very, very handy having Alessia about. So we're supposed to start with a driving test, a quiz. I can ask you some questions if you want, or we could just sort of move on. I can assure you, whichever sessions you're going to after this, there's going to be lots of questions, so I'll maybe keep you fresh for that and we can just get into the content, I think. But maybe just a question of everybody here. Anybody who deals directly with motor insurance and motor taxes, or are we got a sort of a range within the room? Or? Yeah, a few people dealing with motor taxes and so on. So hopefully what I'm saying isn't going to be totally new, but we'll see. So we're looking to split this next half an hour or so into sort of two chunks. Firstly, looking at sort of general themes that I see across motor taxes, sort of things to be looking at for a very high level general ideas, and how motor taxes maybe differ from other taxes a bit in that regard. And then we've got a list of countries that we're going to sort of dig into the detail a bit more, depending how much time we get. We might not get all the way through to the joys of the annual adjustment in Denmark, which can get quite complicated. So we'll just see how time goes. And if you've got any specific questions that you'd like to sort of pick up afterwards, that's fine. But I'm also very happy for this to be, it's a small room, small group, so just, chip in with any ideas or questions or experiences, at any time, and just try and keep it fairly informal there. So we maybe start with just sort of giving a little bit of context to motor business. Takes up 30% of premiums, non-life premiums in the EU, so representing the biggest chunk of premiums of sort of various sectors. But generally written on a domestic basis, very, very much more a domestic tax, not so much a freedom of service tax, with only 1% of motor premiums on freedom of service and 2% on freedom of establishment. So it's maybe explaining why we're such a small group here, but the freedom of service business is not so big for the motor taxes. Not to say it's not there, but it's not as big. So next on to some sort of further general themes that we have on motor taxes across the EU. So I'll hand over to Alessia for a bit.
Yeah, as you may know, IPT on motor third-party liabilities may be quite different from the other classes of business. So if we start from the number of taxes, we can see that general liability policies are usually subject to just one tax, with some exceptions like Ireland, where there are 3 charges, or Sweden, where general liability is exempt. So we can see across Europe the average is just above 1 tax per premium. But if we look at the motor third-party liability, we can see how this number increased quite a lot. And if we take, for example, France, we can see that a general liability policy is subject to just 1 tax. But when writing a motor third-party liability, the premium would be subject to 6 different charges. And this is because this kind of insurance is usually used by the central government on the different countries to fund specific funds. So, for example, they add parafiscal charges to the premiums in order to fund services to the collective, like emergency services or road maintenance. But it can also fund specific entities that are going to compensate the road victims' families, like we have in Italy. And
Yep.
So we can see that the average across Europe for motor third party liability is double as the one for general liability, because it's almost 3 charges on applicable to the premium.
So if we then sort of perform the same analysis with the number of tax returns you're going to have to submit if you're writing business throughout Europe, general line, now I will start, Spain has ruined this graph a bit for me. It was, when I started it was a very good graph, but then we added Spain and it's sort of shrunk everything a bit everywhere around it. But on a general liability, sort of the number of tax returns in a year, you're often looking at around 12, you know, 1 a month, maybe in the UK 1 a quarter. So an average, yeah, just below 20 on a general liability. Motor third party liability, however, then, story's the same. There are more tax returns, significantly more. You look at Belgium, the number of tax returns that have to be submitted, well over 40, approaching 50 in a year. France, over 40. So then the average is well, just over 20 there. So it's a much higher compliance burden on the insurer when writing motor third party liability. And just an example there, I mean, again, Spain has maybe warped this a bit, but most third-party liability, if you're writing in Belgium, France, Portugal and Spain, in any 1 year, you'll have to submit 225 tax returns, just for writing most third-party liability. So it's a big burden on the insurer, from an administrative perspective.
Yeah, but then when we look at the tax rates applicable to the 2 classes of business, things get a little bit more interesting. So if we look at general liability, the average across Europe is just above 10% applicable to the premium. But then if we compare it to motor third party liabilities, then the rates goes up in quite a few countries. So if we look at if we look, for example, at Denmark with the highest rate, general liability is taxed with a 1.1% rate, but the motor third party liability has a 42.9% rate. The second highest rate is in France, where all the different charges add up to a total 35%. This obviously means that there's a higher risk for the insurance company, because obviously higher rates, it can come to a relevant impact on the profits of the insurance company. So in case of, for any reason, insurance company is not compliant, then the consequences can be very relevant on the profits and can lead to a loss as well, if we consider penalties and interest applicable. If we have a look then at the average of the rate applicable to motor third party liabilities, we can see again it's double as the average calculated on general liability policies, because it's just above 20%.
So we've had a little look at sort of motor third party liability and the extra cost, the extra administrative burden. But you know, when you talk about motor insurance, we haven't really yet nailed down what it means, and when it comes to IPT, it can be a very broad or a very narrow idea of what motor insurance is. So you've got your first, you know, a chunk of the class 3, the own damage, looking at damage to the hull of the vehicle, and then you have your, you know, third party class 10, the compulsory coverage. From a tax perspective, these often get different treatments. So then when you have a fully comprehensive product, you have the issues of the apportionment, identifying the own damage element as opposed to the motor third party element. In some territories, it'll be a flat rate. So it's a motor policy, so you apply the motor rate. But then in other countries, such as Denmark, you do apportion. And as we've seen in the previous slides, the potential arbitrage there is quite big, with the third party liability tax being 42%, 42.9%, and the own damage being 1.1%. So quite a big difference. But if we get onto the Danish piece, there's various rules and regulations which stop any sort of value shifting there through very difficult calculations. But then there are also other associated products, add-on products, which have been tested quite a lot in courts, in case law, looking at the sort of gap insurance, how is legal expense insurance is treated when it's in association with a motor vehicle, equally accident, extended warranty, and many others. And you find that in many territories, you say, okay, well, I'm writing a legal expenses contract, well, that's fine, there's your rate for legal expenses, but it's in relation to a motor vehicle, so straight away the rate goes up because it's in relation to a motor vehicle.
So, as you can see over the next few slides, we're going to have a look at the elements that can affect IPT calculations and application. The first element is, of course, the location of risk, but in some countries it's relevant, the type of vehicle you're insuring, because the tax application can vary. So what we want to say with these elements is that it's really important to have a good quality information from the underwriting department. This is because we need to know very detailed, we need to have very detailed information to apply the correct rate and to identify the correct premium.
Yeah, so I think now if we just go into each of these areas a bit more and explore a bit more there what Alessia has been saying about the quality of underwriting information needed and policy details needed in the tax department or whoever's calculating and settling those taxes to be able to do it accurately and efficiently. Now, I'm not going to dwell on location of risk because there's another session on location of risk later which you may be going to, and for motor vehicles it tends to be a fairly straightforward, one of the not quite so contentious areas maybe, essentially looking at the member state registration of the vehicle. So that's fairly okay. It gets a bit trickier, however, when you go actually into the territory itself, into the state itself, and there are a number of territories which require information to provide the correct tax calculation of where the vehicle is in territory. So it's no use, for example, Spain, it is no use just saying the vehicle is in Spain. You have to identify where in Spain it is because of these provincial filings that are required for insurance premium tax to the four provinces it's sort of in the Basque region, Álava, Guipúzcoa, Navarra and Vizcaya, all require their own declarations. It's the same rate of IPT, still 6% as it would be to the central administration in Madrid, but you have to identify the vehicles that are registered in those areas to be able to declare the appropriate IPT to those provinces. In the UK, we have a fire brigade charge in central London. So to determine whether your motor vehicle should be subject to it, your policy should be subject to it, is A, you have to consider does it cover fire, my policy, and if yes, is the car stored or garaged in the inner London boroughs? So it's not necessarily where your car is registered in this case, it's where it's stored or garaged. And actually the authorities that administer this additional charge are very open to negotiation, they're very pragmatic and practical, and they're saying, okay, well there could be considerations with fleets, how we will do with that, well we'll look at the pattern of what's happening with that fleet and we'll come to an amicable agreement that works. But essentially if you've determined that your vehicle is stored or garaged in the inner London boroughs, you'll have to pay £35 for every £1 million insured value. And then finally, Italy. How many states? How many provinces?
110.
110 provinces in Italy. Each province has the right to change their rate on IPT on motor third-party liability insurance. So that's 110 provinces that you have to monitor, constantly monitor, make sure that you've got the correct rate. The sort of default rate is 12.5%, and then each state, each province has the authority to increase or decrease that by 3.5%.
Yeah.
So,
excuse me, how much did you say?
the starting point is 12.5%,
Okay,
and then they can increase or decrease. So it's significant differences if you're getting it wrong. So from 9 through to 16% of the possible rates, and in fact they can change it whenever they want. Each province can decide that actually we're going to change the rate now, and they have to give a month's notice, I believe, or maybe 2 months, publish it and give time to adjust, and then it's effective. So constant monitoring of the various sources of information, the websites, the national websites and the provincial websites to ensure that you have the correct rate. But from in terms of information, again, you're going to need to know the location of where that vehicle is registered to ensure that you're getting that correct rate applied. And then, when declaring it, you have to separate that out. So a motor insurer in Italy can find themselves with 1 page per province, so the tax return can be 110 pages plus the sort of four original pages. So it's quite a task to compile all of that together. So we've looked at where is the vehicle. Another key factor when it comes to premium taxes on motor is the type of vehicle and what's it being used for. So some examples are Spain on motor hull, motor own damage policies. There are fixed fees for different types of vehicles. So you need to know exactly whether your vehicle is over that 3.5 tonnes or not, as whether it falls into a car, which is with one rate, or a truck, which is another rate. So when you have large volumes of premiums, large volumes of policies coming through, it's essential that you have the correct data in your reports to ensure that A, you've priced your premium correctly, and B, then that you are remitting the correct taxes onto the tax authorities, and actually in this case it's the consortium. In Belgium, again, we see different rates for different weights of vehicle, but also then different rates for whether the vehicle is a purely private or if it's commercial use. Similarly again in France, you have to look at the use of the vehicle. Is it private? Is it commercial? But also then again in France we have an additional consideration: is it used for agricultural purposes? Can attract each three can attract different tax rates and in fact different taxes. And then also on the own damage policies, there's the issue of the catnap premium, which needs to be addressed, which, whilst in itself is not a tax, it's additional premium that changes depending on the types of risk covered and how the contract is structured. And we'll have a little look at that in a bit more detail when we get on to
Belgium and France, you're looking, is that the first party part of the policy or the third party or both?
Both it can have an impact. The taxes in Belgium are pretty wide-ranging when it comes to motor. There are a lot of them, and they different authorities. So what's really quite complex here is you have two different authorities administering this, and the two different authorities have their own rules. So just because you have a commercial vehicle under 12.5 tonnes doesn't mean it's going to fall into the same category for both authorities, if you see what I mean.
And those authorities are what drives the insurance under those different authorities?
Well, it's the taxes. So the two administering authorities are the Treasury, the sort of the national government collection agency, and then you also have the INAMI, and it's sort of their institution for funding the emergency services and so on. So, just sort of summarise a bit there. All this information should be sort of known and collected at the premium pricing stage, really. So it's no good getting to the end where you're just about to you know, sign on the dotted line with your return and realise that actually you should have split out all of this information and actually it's changed the tax calculation because you've priced your premium incorrectly, probably, and you could be at risk of you know, completely underpricing your premium in the case of Denmark if you've not done it. With 42.9%, it's going to go very wrong. So then, yeah, there's all this information, but the question is it filtering through to the tax department or to the person responsible for submitting the returns? So you might have a very good, well-coded underwriting system which is pricing the premiums and calculating the taxes absolutely spot on. But if your reports going through to your tax department that is reporting these taxes aren't good enough to be able to split this information out, to show on the return, to prove to the tax authorities that it's the correct application, well then you're going to have difficulties completing the return and maybe have to pay a higher tax because you don't have the quality of information that's needed. And that's sort of, yeah, that third point there, are the codings sufficient? Have you done that work at the first stage to ensure that you have enough codings within your underwriting systems, within your sort of brokerage systems that are meaning that the taxes are right from the start? Right. So we'll now sort of dig a bit deeper into some of the country specifics. I'm going to have a little rest. You're not, but we're sort of going to go on to Italy, so
Yeah.
unless
So-
you want to do a bit of...
Yes, we're going through Italy now, and as Joe said before, it's really important to know where the vehicle is registered within the country. So this is because the IPT on motor third party liability is paid direct to the single provinces. The general legislation established a default rate of 12.5%, but it gives to each of the provinces the authority to increase or decrease the rate by up to 3.5%. So we're going to have provinces like Bolzano, where the rate is 9%, or provinces like Rome or Milan, where the rate is actually 16%. So it may be that the policyholder has his domicile in a province, but the vehicle is registered in a different one. So when pricing the premium, you obviously take into consideration the domicile of the policyholder, or where the car is stored, or the garage where it's stored. But when calculating the IPT, you need to consider what the vehicle is registered, or a very different rate may apply. When the rate changes get into force, the provinces take the decision to change the rate, and this is published on the central government website. And the change gets into force on the first day of the second month following the publication. So let's suppose the change is published today. This will get into force from the 1st of January. Then we need to report separately the amounts due to be paid to each province in the monthly return. And there is an annual reconciliation to be made by the end of May of each year, and this is the motor reporting, which is embodied in the April return. Then an additional contribution is due if your policy has a fire element. This is a special contribution to be paid to Trentino Alto Adige region. So if the risk is located in this region and the policy has a fire element, you are liable to pay this fire brigade contribution to the region, which entitled the insurance company of an IPT credit in the following IPT payment. The other thing to get into consideration is when calculating the prepayment to be paid by the middle of May, the base calculation shouldn't include the IPT paid on motor third-party liabilities contracts. So when calculating the prepayment, you're gonna take all the premium collected in the previous year and deduct the IPT on motor third-party liabilities. In addition to IPT, we have the emergency fund contribution and the road accident victim fund contribution that we call RAVF, just to make it short. Unlike the other two, so unlike IPT and emergency fund, RRVF contribution is an insurance tax, so the cost of the tax is borne by the insurance company, and this must be taken into consideration when pricing the premium to the policyholder in order to recover the tax the insurance company is going to pay. RRVF is paid and declared separately from IPT and emergency fund. There is a provisional payment to be paid in January and then an adjustment payment to be made by the end of September of the following year. The base calculation is the premium collected 2 years earlier, so if we're going to calculate the 2015 provisional payment, we're going to take the 2013 premiums collected and reduce this premium by a management fee rate published annually by IVAS, the Italian regulation. This year, I think it's 5.1%.
Have you got all of that?
Yeah, we have an example later. And the RRVF rate is 2.5%. So once you have calculated your reduced premium amount, you're going to apply the 2.5%. So if we see the next slide, if we have a look at the next slide, there is a work example. I'm not going through the calculations because they're quite complex. But if you see, for the 2014 provisional payment, we have applied 90% on the premium collected in 2012, €90,000, and we have that provisional payment of 2,135.25 euros. In September 2015, we're going to calculate the adjustment, and this is based on the premiums actually collected in 2014, applying the management fees for 2014. Obviously, if your provisional payment was higher than the contribution that you had already, should have paid, Consap refund insurance company quite usually in a short period of time. They're quite efficient. Consap is the entity managing this fund, and it's a separate entity from the central tax office. The next slide has another work example with all the charges applicable to multi-third-party liabilities policy in Italy. So if you see, let's suppose that the insurance company wants to charge the policyholder by €300 because of the risk related to that vehicle, then the insurance company should take into consideration RRVF and mark up the premium to apply to the policyholder. This is, as I said before, to recover the RRVF that you're going to pay in the following year. And then when it comes to applying the RRVF, you can see the amount is actually 7.29, and then the net premium collected by the insurance company will be 300, the one that reflects the risk related to that policy. I'm not going through, again, calculation of IPT and emergency fund. If you have any question and any doubt, feel free to come to me later and ask whatever question you want. Yeah.
So, have a little...
Can I just go back on Italy, where you've got the registration by location?
Yeah.
Is there perceived to be a risk if you're registering all your vehicles in one location and you have an office to do that, have a presence there, that those vehicles are actually being used throughout Italy? Has that been seen as a risk at the moment or not yet?
But the vehicle should be registered in the province where the first owner has his domicile. So if the vehicle is then consequently sold to another person.
No, not sold, used.
Well,
Yeah,
it doesn't matter where it's used.
But it's the example that's come up that has yet to be properly tested, I believe, is that of fleet vehicles.
That's where I'm coming from, a car rental
exactly,
position where you
exactly.
register all your vehicles in a low site
and
you use those vehicles throughout Italy.
I've certainly seen insurers taking the decision to register in the lower area. It's yet to be tested, but so we don't know at the moment what the tax authorities would do. There's nothing in the law that says you can't register the vehicle wherever. So it appears legal, but what the tax authorities' view on that has been so far has not been tested. Nobody's yet wanted to say, oh, we've got all our vehicles registered here.
It's more the provinces that are going to squeal if they're having vehicles used in their provinces, but they
Yes.
haven't got the tax revenue because
Yes.
it's been registered in Bolzano,
Yeah.
for example.
And in that sense, you've then got quite small localised governments, local governments that just don't have the sort of resources or power to dig into that, because they also have to compete with then the central administration that is administering the whole thing. It's still all collected and paid centrally, and then the central government distributes it out amongst the provinces. So, yeah, and but the flip to that is the many provinces are lowering their rates to encourage the registration there, but it's yet to be tested. So we don't know how the authorities and how each province would react to that. I would say so long as you can justify the reason for the registration in a certain province, and that there's more reason than just to avoid higher rate of tax, then I don't want to say anything definitively when it comes to the Italian tax authorities. They can be a little unpredictable. So, we have a quick look at France. Won't dwell too long, but essentially, as we said earlier, lots of different contributions to consider, lots of different taxes, lots of different tax returns. Actually, lots of different filing deadlines and frequency of return. So France motor contracts can get quite involved in making sure that everything has been settled correctly and timely, in a timely manner. As I said earlier, there's the catnet issue. Now in France, the issue of the catnet is only an issue for the own damage policies, and it's not a tax issue per se, but it does impact onto the tax calculation. As we've seen, there's the Major Risk Prevention Fund, which is 12% of the catnet premium, and there's also IPT, which is due on the catnet premium as well. So there's an additional premium required to be collected by the insurers in case of natural catastrophes. And in terms of motor, the rate of that additional premium is either 6% of the base premium or 0.5% of the base premium. Now, it takes a little while to get your head around which one applies, but the 6%, I think this sums it up fairly clearly. The 6% applies to fire and theft cover, where a policy covers fire and theft and other damage. The 6% only applies to the fire and theft element. However, where there is no fire and or theft, 0.5% applies to the other damage. So the 6% will only apply to the fire and theft. If there's no fire and theft present, it's essentially 0.5% to the whole premium. And then following that, your IPT at the applicable rate and MRPF at 12% will apply onto that additional premium as well. The thing about France, which is maybe requiring a little bit of consideration, is case law. There's a lot of case law in France around tax generally, but specifically also on motor, and probably due to, in part due to the difference in rates that are out there. So the general rules are 18% IPT for insurance against risks of any nature related to motor land vehicles. And then the next chunk, for any other insurance, 9%. So a lot of the cases have centred around this phrase, related to motor land vehicles. When is it and isn't it related to motor land vehicles? The individual cases are specific to the facts of that case, so can't necessarily be applied across the board, but very often the French administrative guidance sort of formalise them, these rulings, so that they can be applied across the board. Some of the key cases was looking at driver and passenger insurance. It's the driver and passenger, you know, the sort of personal indemnity, injury, accident elements of a policy are the driver and passenger elements related to a vehicle. I believe actually the driver receives a 9% IPT rate because he's not related to the motor vehicle, but the passenger is, and the passenger is taxed at the 18%. Again, similar cases looking at personal belongings, legal expenses, when is it and isn't it in relation to the motor vehicle. We've got time to start on Spain. Actually, Spain for once is not too difficult when it comes to motor, so long as you've got everything set up correctly. We've mentioned the provincial filings before, and also this fixed fee. So we've just sort of thrown this table in there, which is the various rates that apply for different vehicles, and that's sort of the level of detail that you need to be establishing at the premium invoicing stage, premium pricing stage, to make sure that you've got your correct consortio cover. In addition, there's also the extra 2% due to the consortio on the motor third party premiums. Austria, this is where we start to really get into complexities of some of the harder calculations that are out there, and really needing the very minute detail. In Austria, you have IPT at 11%. On own damage policies, you have 8% fire brigade charge, but only charged on 0.25% of the premium. So quite often it's so small it doesn't even register as a cent. But then you have the vehicle insurance tax on Class 10, the motor third party policies. And this is dependent on the vehicle engine size in kilowatts. In the UK, we don't really use kilowatts when talking about cars, so it didn't really mean very much to me when I was first looking at it. So the example I've put up there at the bottom here is the case of a Renault Clio, just to sort of give an understanding. Apparently Renault Clios are around 75 kilowatts power, the sort of standard model. So what you have to look at when calculating this Austrian tax is you have to take the power of the engine, you deduct 24 kilowatts from that, no matter the size of the engine, take away 24 and then times that by 55 cents to get your contribution. If you're receiving the premium in instalments, however, the tax amount changes. So if you collect all up front, that's your calculation. If you receive it in 2 instalments throughout the year, it goes up a little bit, I think maybe by 5%. If you collect it quarterly, it goes up by 7%, and if you collect it monthly, it goes up by 10%. So collecting your premiums on a monthly basis actually increases your tax contribution. Right, we're pretty much at the end of our allotted time. So there is Denmark. I won't start on Denmark, but essentially we have this arbitrage between the two classes, and then every year you have to make an adjustment looking at the value of your claims under the third party. So if you have underpriced your third party liability premium, it will get picked up when they look at your claims history, and you'll have to make an adjustment payment of 47.2% of the claims paid. So if you have a very big claim in one year and you haven't yet collected very much premium, then that can be a serious cash flow issue. You can claw it back in later years, but it can be quite a big shock to start with. So that's sort of our time up. There's the bell. If you have any quick questions, I'm happy to take some now, but I'm around all day. So do come and find me or Alessia if you would like to discuss anything or speak to us further about it. Thank you.
Thank you.